Let's talk about the Federal Reserve, the stern parent of the U.S. economy. It's the institution that quietly shapes the financial world we live in, often working behind the scenes to keep things running smoothly. The Fed sets the rules, hands out the allowance, and sometimes grounds the whole financial system. It's the ultimate authority, deciding when to tighten the belt or loosen the purse strings for everyone. But lately, this parent has been acting strange, making moves that even seasoned financial experts are struggling to explain. While telling everyone to save and be cautious, it's been quietly slipping billions to big banks, almost as if it hopes no one will notice the extra cash changing hands. In just 1 month, the Fed pumped over $40 billion into the banking system, hoping no one would notice. That's not pocket change, it's a massive sum, enough to raise eyebrows across Wall Street and beyond. This isn't a rounding error. It's a deliberate, calculated move that signals something unusual is happening behind closed doors. On December 30th alone, the Fed funneled $16 billion overnight, the second largest such move since the COVID-19 crisis. That's a staggering amount to inject in a single night, especially when the headlines are quiet. It's like the fire department showing up in force to water a single potted plant. The response seems out of proportion to the visible problem. You have to wonder, if the response is this dramatic, is there a bigger fire we're not seeing? What's really going on beneath the surface? These interventions are supposed to be for emergencies, not routine Tuesdays. When they become regular, it's a sign that something is off. What's more concerning is the secrecy. The lack of transparency only adds to the sense of unease. No press conferences, just quiet technical operations buried in financial data. Unless you're looking closely, you'd never know it happened. When the Fed acts like a teenager sneaking out, it's a sign something's wrong. Responsible institutions don't hide their actions unless there's something to hide. They're managing a problem they don't want to discuss publicly, a red flag for the rest of us. It's a warning that shouldn't be ignored. Beneath the surface of our strong economy, serious cracks are forming. The foundation isn't as solid as we're led to believe. Banks, the institutions that hold our savings, are running short on the one thing they can't afford to lose: cash. When liquidity dries up, trust in the system starts to erode. When desperate, they don't turn to each other. They run to the Fed for a bailout. It's a last resort, not a routine business practice. This isn't just about numbers. It's about the stability of the system we all depend on. When the foundation shakes, everyone feels it, whether you're on Wall Street or Main Street. You might hear repo operations and think of car repossession. In finance, it's not far off, a high-stakes pawn shop for banks. Banks hand over safe assets like treasury bonds to the Fed for quick cash, promising to buy them back the next day with interest. Normally, these overnight loans are boring background plumbing, keeping banks liquid. But a sudden surge in repo use is like every fire hydrant in the city being opened at once, a clear sign the system is desperate for cash. Why is this alarming? It means banks can't get cash from each other, usually because they don't trust one another. When trust breaks down, banks bypass each other and go straight to the Fed, the lender of last resort. The recent $16 billion operation shows private markets couldn't meet the demand. The Fed was the only lifeline. This isn't just technical, it's a distress flare from the heart of the banking system. Why are banks suddenly desperate for cash? It's a question that's making headlines and rattling nerves across the financial world. The answer isn't about gold-plated office chairs or lavish perks. It's rooted in the very structure of modern banking, which is more complex than ever before. After the 2008 financial crisis, strict regulations forced banks to hold large amounts of safe assets, like government bonds. This ties up their cash, making it harder to access money quickly, and creating a constant thirst for liquidity. But that's only part of the story. Trust is another crucial issue. In good times, banks freely lend to each other overnight, keeping the system running smoothly and efficiently. But when uncertainty rises, like during economic shocks or rumors of trouble, banks start hoarding cash, worried their peers might be hiding problems. This breakdown in trust forces banks to fend for themselves. Those unable to find cash privately are left with no choice but to turn to the Federal Reserve for help, often as a last resort. Managing a bank's balance sheet becomes a high-wire act. One misstep, and a bank can appear healthy on paper but still lack the cash needed to pay its bills on time. As some banks get squeezed, others grow even more nervous. Lending dries up, trust evaporates, and the cycle of fear and caution only gets worse. The repo market is designed to break this cycle by letting banks borrow cash short-term. But when demand overwhelms supply, the repo market itself becomes a symptom of the deeper problem. The recent surge in repo rates shows banks are struggling to meet their daily obligations, running on fumes with the Federal Reserve acting as the only gas station open late at night. It's a vicious cycle of fear, cash shortages, and growing uncertainty, one that can ripple through the entire financial system if left unchecked. Year-end is chaos for banks, their financial final exams. Banks want their balance sheets to look safe, so they pull back from lending and hoard cash, causing a predictable liquidity drain. It's musical chairs. At midnight on December 31st, nobody wants to be caught without a seat. This happens every year, but when the system is already fragile, the squeeze can push it over the edge. The Fed's $40 billion injection, especially at year-end, was a direct response to this dynamic. Without the Fed, short-term rates could have spiked, causing chaos. The forceful intervention shows just how thin the buffer has become. Just when it seemed the financial world couldn't get more complicated, the Federal Reserve steps in with yet another headline-grabbing move: direct bond buying, right back in the spotlight. Officially, the Fed calls this a reserve management program, a technical-sounding name that doesn't quite capture the scale of what's happening. Unofficially, though, it looks and feels a lot like quantitative easing, QE, the same playbook used during past crises to flood the system with cash. The Fed is poised to buy up to $220 billion in government bonds over the next year, starting with a hefty $40 billion each month, an enormous sum by any measure. This is essentially new money, created out of thin air and injected directly into the financial system, boosting liquidity almost instantly. Here's how it works. The Fed buys a bond, credits the selling bank's account with fresh digital dollars, and suddenly that bank is flush with extra cash to lend or invest. Unlike the quick overnight repo fixes we've seen before, this is a sustained, long-term injection of liquidity designed to keep the gears of finance turning smoothly. The scale is massive. $40 billion a month is a powerful intervention, ensuring banks remain awash in cash and markets stay liquid. The Fed insists this is just to keep markets functioning, not a stimulus program, but plenty of critics and analysts aren't convinced by that explanation. Whether you call it QE or something else, the effect is the same. More money in the system, a swelling Fed balance sheet, and a market that's being carefully managed. No matter what label they use, it's a clear move to ease financial conditions and keep the economic engine running. This new bond buying program is a stunning reversal of the Fed's recent policy. Since 2022, the Fed was fighting inflation with quantitative tightening, QT, shrinking its balance sheet and pulling money out of the system. The goal: tighten conditions, slow the economy, and bring down inflation. The Fed's balance sheet dropped from $9 trillion to $6.5 trillion, and officials talked tough about staying the course. But as QT continued, the system started to creak. Repo market chaos and bank stress were direct results. The Fed realized the system was so addicted to liquidity that even a partial withdrawal caused severe symptoms. Faced with a choice, fight inflation or prevent a meltdown, the Fed quietly chose stability. QT was halted, replaced by a program that does the opposite. This U-turn raises questions about the Fed's credibility and long-term strategy. It seems the Fed can't tighten without breaking the system, or ease without risking more inflation. Here's the contradiction. The Fed talks tough on inflation, but its actions are soft. Publicly, officials stress their commitment to price stability and higher rates, but behind the scenes, secret liquidity injections and new bond buying programs are easing conditions. It's a two-faced policy. Talk like a hawk. Act like a dove. Why? The Fed is walking a tightrope. Announcing full-blown QE could spook markets, letting the system seize up could trigger a crisis. So they split the difference. Hawkish talk, dovish action. Critics say this damages the Fed's credibility. By calling its new program reserve management, the Fed is playing word games. But if it looks, swims, and quacks like QE, it's QE. The balancing act may not be sustainable. This isn't just an American problem, it's global. Central banks worldwide talked tough on inflation, raised rates, and promised to shrink their balance sheets. But at the first sign of stress, they reverted to printing money and providing liquidity. The global financial system is addicted to central bank support. Global liquidity has surged to an all-time high, nearly $490 billion injected in a short period. The Fed, European Central Bank, Bank of Japan, they're all doing it. Publicly, they promise to fight inflation. Privately, they're terrified of a crisis. The system is too fragile to withstand higher rates and less liquidity for long. The result, central banks may have lost their ability to truly fight inflation, shifting their mandate to financial stability at all costs. For ordinary people, this means persistent inflation and repeated bailouts for the system that causes the instability.